Consumer Price Index. That's our topic for today's Backstage Pass. Well, hey friends, I hope you're having a great day so far today. As we move into the afternoon session, stocks are mixed. The NASDAQ and the S&P are up. The Dow Jones is down just a little bit. Mortgage bonds are up though, and we'll talk more about that in just a minute. But first, let's talk about the topic du jour. That's CPI. Consumer Price Index data for the month of November was released today. The markets have been waiting on it. Everybody's been waiting on it. Finally got that data. So hey, let's dive in. November CPI showed that overall inflation increased by 0.1%. This is what's known as headline inflation. That was 0.2% below expectations or below forecast. Now, year over year, inflation declined from 7.7% to 7.1%. That was moderately cooler than the 7.3% forecast. But the real story here is the core rate. The core rate strips out food and energy prices, and the reason why the core rate is the real story is because, well, that's what the Fed is looking at, regardless of PCE or CPI. The Fed is looking at that core rate because of the amount of volatility that is in food and energy prices. The core rate increased in November by 0.2%. That was still better than what was forecast. It was forecast to increase by 0.3%. Now, as a result, year over year, core inflation decreased from 6.3 to 6%. That's lower than the 6.1% expected. Now, here's the deal. This is what's really kind of driving this core rate right now. It's shelter. Shelter rose by 0.6%. It's now up 7.1% year over year. The components of that shelter, well, there's rents. Rents are up 0.8% last month. They're now up 7.9% year over year. Owner's equivalent rent, which tries to capture the rise in home prices, that was up 0.7% and 7.1% year over year. Now look, the CPI shelter costs, they're still catching up and they're still adding inflationary pressures because we know real shelter costs have been on the decline. They're starting to decelerate. But again, because shelter makes up 39% of the core CPI, it was the main cause for that 0.2% monthly gain. Shelter's a lagging data point, so when this does catch up, we could see an even more significant decline in inflation. We're looking for that in around January, February timeframe. And some more of the other internals, well, let's take a look at energy on the headline data. Energy overall month over month decreased by 1.6%, still up about 13% year over year. And gasoline prices, well, they fell about 2%. They're up about 10.1% year over year. So how have the markets responded? Well, the markets opened up this morning down 20 basis points. Mortgage bonds were down 20 basis points, but they opened up before CPI data was released. As soon as that data was released, they flipped 50 basis points to the positive. They were up 30 basis points. They got as high as 80 basis points up on the day, and they've started to recede. We did have one other newsworthy event that happened today. That was a 30-year Treasury auction. That's kind of put a damper on the gains that the mortgage bonds have been seeing. So mortgage bonds are up about 45 basis points at the time of recording. 10-year yield, well, that's down about 12 basis points at the time of recording, and it's been moving around as well just based on the 30-year Treasury auction. So good swing, a good movement in the right direction. The national average for a 30-year conventional fixed-rate mortgage ended the day yesterday at 6.38%. But we do expect that based on market movements to improve today. We'll let you know tomorrow where that kind of wound up today based on today's market movements. And listen, the day is really still kind of young. We're in the early afternoon session, but there still could be a lot of movement in the bond market throughout the rest of the day. So we'll keep an eye on it as it happens. Now, what's next? Well, the next thing is the Fed meeting. As they started their open market committee meeting today, they're going to be wrapping that meeting up tomorrow. They're going to be announcing a 50 basis point rate hike, and then they're going to have a press conference. Fed Chair Jerome Powell is going to do a press conference. So we kind of have an idea about what they're going to say. They're raising the Fed funds rate by 50 basis points. How they say it is going to be important, and that is the next thing that the markets are going to be watching tomorrow. Could it add to this rally in the bond market if the Fed is a little more dovish, if the Fed says, hey, we still have some work to do, but the efforts that we're making to try to tame inflation, well, these efforts are starting to work, and we're seeing the signs. The Fed comes out and says something along those lines, a little more dovish. well, we could see a little bit more of a rally in the bond market. And here's the main reason why I want everybody to understand. The main reason why is even though the Fed is raising their Fed funds rate in order to help slow inflation down, well, the mortgage rates are tied to mortgage bonds, and bonds are a fixed rate of return investment. So whenever inflation goes up, that fixed rate of return investment, the value for that investment and the return for that investment, well, that goes down. That's the yield. It's worth less because inflation is going up. So as inflation starts to come down, well, that's why we see mortgage bonds start to go up in price and mortgage rates start to come down, because inflation coming down, well, that helps the bond market. So that's why even though the Fed fund rate, they're raising that Fed fund rate, we're seeing mortgage rates come down with inflation as expected, because, well, inflation is the enemy of the mortgage bonds, and mortgage rates, they're based on the prices of mortgage bonds. Now, that's all the news that we have today. Again, tomorrow as the Fed meets and as they bring their news and their press conference, and again, how they say things, we'll bring you that news as it comes. But until then, remember to stay positive. Have a great day. We'll see you tomorrow.